Welcome to Order Flow Trading course, lesson number 6, different types of trading in the market. My name is Michael Valtos. I'm the founder of orderflows.com. First, a disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Different types of trading in the market. Lesson 6. There are different types of trading occurring in the market every day. You have speculation, hedging, long-term trading, short-term trading, trend following, fundamental trading, technical trading, algorithmic trading, and much, much more. You could write a book on the different types of traders and tradings going on in the market. Does it matter? No. People have you believe, you got to follow, long-term trading is the way to go, short-term trading is the way to go, trend following is the way to go, fundamental trading is the way to go. There's really so many different ways to approach the market. You could read the book Market Wizards, and everybody in the book is a successful trader. Do they all trade the same? No, they all have different ways of trading. You could spend your life trying to analyze all the different ways of trading, or before you even start to trade. What you want to know is why the market is moving, when it's moving, and how to get in on the move. I mean, that's what trading profitably is about. Is getting in before the market moves and catching the move. Now, one of the things that people don't understand is before the market moves, there has to be a reason for the market to move. And it's often going to start when there's a big order coming into the market. The market's just not going to start moving for the sake of moving. There has to be an impetus in the market, something to get the market started. And you don't know what's behind another person's trade. You don't know when that 2,500 lot order hits the sales desk that needs to be executed. What you want to be is you want to be ready for, when that big order starts coming into the market, that you can react and trade against it. Now, what is important is seeing what the different types of traders are doing and did in the market to make your trading decisions around. You can't compete with the big institutional traders. You'll go broke. What you want to do is you want to see what they're doing, and ideally you'd like to be in the same direction. Honestly, you're trading, 5 lots, 10 lots, say even, 25 lots. And, you're going against a bank that's got a position of 2,500 lots that they're trying to accumulate. And, you're trying to go against them with a 25 lot order. You'll get run over. You'll get, eaten alive, so to speak. You don't know when the big order is going to be hitting the trading desk. To me, it's like sometimes, these banks, the traders are just sort of lying and waiting for the market to show signs of life, and, they'll pounce. I mean, the lion in Africa, he's just sitting there waiting for his opportunity. He's just patient, more than anything else. A professional trader, a successful trader, is patient. They're not action junkies. They don't like to just get in and get out, live for the action. They want to be around for a long time. They got families to feed. They can afford to be patient and, wait for the right opportunity. But, once an institutional trader starts to get into the market, they're going to leave behind evidence of their view of the direction of the market. You can see their volume that they trade. You can see it in the volume footprint chart. Like I said, they can't hide their trades once they're executed. They could try and hide the trade as it's happening. They're not going to show, 500 lot when they've got, 3,000 to buy. They'll show 25 at a time, but, the order will keep refreshing and it'll show up in the volume. Traded volume on the bids and offers provide the clues that the trader, regarding the intensity of the move in areas where they have backed off. So, if you have an area that's being defended by, a big trader, you're going to see it in the volume. They may not be showing the full size. If you're looking at the book, the bid offer, you may see, a size of 10 by, 10 on the bid, 50 on the offer, but the guy that's got 10 on the bid, may have 1,200 behind it. He's only showing 10. And you're thinking, there's only 10 on the bid, it's not that strong, but it actually is strong. But what you want to see is you want to see what the volume is at that price, how much is traded there, and determine if they're defending that area, or if they're done defending the area, say they got no more bullets. They may have lost interest already and given up and say, okay, I'll take my lumps and I'll come back again and reassess the market later. Now, this is something you hear a lot with order flows nowadays, is when a trader goes long in the market, he automatically becomes a seller in the future. Or when a trader goes short in the market, he becomes a buyer in the future. In general, yes, that's the case. For obviously for retail traders, yes. For some traders, no. They may very well buy with the intention of taking delivery or making delivery if they're short. It's not always the case that as soon as someone is long in the future, they'll be a seller. More often than not, yes. But it doesn't necessarily mean that they're going to be a seller, in the next 10 minutes. They may be a seller in the next 5 weeks, if that. It really depends on the price movement that affects the trader's decision once they're in a position. I'm referring to, short-term trader. If the market is moving against them, yeah, they're going to get out relatively quick because by definition they're a short-term trader. If it's a long-term trader, and they go long in the market and the market starts moving against them for a few days, they may not necessarily be looking to get out right away. They'll assess the market and then decide what to do. But for a short-term trader, if the market starts moving a couple points against them, they're already looking for a reason to close the trade and get out. The amount of fundamental information available to traders nowadays is overwhelming. There's no way a trader can see and process every bit of information that may influence, the price of a market. And there's really so much information out there nowadays. You could look at the weather, you could look at, the germination counts for the corn. Really pick any market. There's hundreds of factors that that go in to influence the market. But what you should think about with the information is how it will influence the other traders, how they're going to react to the information. You may think it's something that's very important, but maybe the rest of the market doesn't think it's important. You have to decide if it's something that may affect the long-term views that there could be a shift in supply and demand. When there's shifts in supply and demand, that's where money is really made. You're not necessarily making money on these little fluctuations up and down for a couple of points. You want the big moves where you're going to be able to get a lot of points rather than just a few ticks. A lot of people think making a few ticks is great. If they can just make a few ticks a day, it's happy days, but, in reality, you want to be making points on a regular basis, not just a couple of ticks. You want meaty trades, you want the meat and potatoes. You don't want the little French fries or, the salad to fill you up. You want the big steak dinner. You want something that's going to fill your belly, and, and understanding when there are shifts in supply and demand is, where the big opportunities are going to be. And, you don't need to know, every underlying fundamental piece of information that comes into the market. What you want to understand is, the people that have access to all, the best information, what they're doing in the market. Those are the traders you want to follow. Order flow allows you to take all the little bits of information that's coming to the market and determine the market's psychological response to that information. Like I said, you don't need to analyze every single little bit of information. That's being done for you by the bigger participants, the institutional traders, the hedge funds, the real money accounts, the commercial traders. They're analyzing that, based on their view of supply and demand, and they have a view that, like I said, that you're not going to have. The regular institutional traders is not going to have, insight into the market that the institutional traders have. They know the supply chain, they know the shipping rates, they know everything. Well, at least they pretend to know everything. But, traders buy and sell in response to every little bit of information. And like I said, I think it's, you see these people, they watch TV, they're trading, and, someone says something on TV, all of a sudden they got to sell S&Ps, or buy crude. Well, by the time that information's already, hit the news speaker's mouth, it's already been factored into the market. If you're trying to trade every little bit of information, you're going to get chopped up. Like I said, you want to get the big moves, and, you want to follow the big institutional traders. And you're going to see their response in price and volume that's traded. You're gonna notice when price starts moving away. If you're thinking price should be going higher and it just sort of stops, goes nowheres, and then starts selling off. You're looking. You got to ask yourself, why is it doing that? Everything says is bullish about the market, but all of a sudden, we're not going higher. We're starting to sell off. Why? Why is that? Here, for example, this is a crude chart. The market went up, it started coming down, and, you're seeing these areas where, you get these big imbalances, on this move up. Okay, so, you got 426 sold into the bid here, 504 here. We go back up, you're seeing, well, you got these big selling imbalances. Why isn't the market going down? You're not necessarily seeing big buying imbalances in the other direction. Obviously, you got 679, we started coming off from the high. You got this big selling imbalance here. Why isn't the market selling off? Why isn't it going lower? There's a lot of people selling, 679 lots, 470 below it. You gotta understand what's going on. There's somebody bidding there. When you're seeing size like this in a market, understand your market and understand what's solid size, what's big size for that market. This is a crude market. This is a 10 range chart. You see in 679, 470 right below it. That's 1,000 lots, right at this level. Obviously, there's somebody supporting the market. Earlier you saw, 426, 169, 191, right around it. You're talking 800 here, 500, 295. You're talking another 800 here. So obviously, there's somebody that's interested in buying the little breaks. The market comes up, it comes off a little bit, and they're bidding. They're happy to buy it on a pullback. Market pops back up, comes right back down, and these guys are back in here. They're buying again. Even though there's selling imbalances, and by definition the market should sell off because those are big selling imbalances, but it's not. So obviously there's somebody supporting the market. Being able to spot that is, what's going to make you stand out from the rest of the traders that are trading in the market. So, okay, this is a crude chart, okay, just really quick. market's going up, going up, going up. Okay, you're seeing these aggressive buyers here. You got a big buying imbalance right up here near the high, which is you want to see. That's normal. You're expecting to see a lot of buying happening near the high. People are expecting the market to go higher, and it does. It pops right back up. It hits a new high. You got a divergence up there, which is a sign. Say, ooh, okay, you hit a new high, but you got a negative delta. So obviously, selling came in right at the high, and then immediately after, you get an aggressive selling. You get a stacked selling imbalance, and what happens? The market falls right over. You hit the high, and you see in the order flow. First, you got your divergence. You hit the new high, but where's the rest of the buying? The selling overtook the buying in that bar, and then in the next bar, you got a stacked selling imbalance. Where there's a lot of sellers coming in and kicking off a bunch of selling imbalances, and then the market just sold right off. Again, you've seen this chart a lot, in the earlier lessons, but it's a perfect example. Okay, this is S&P's at 1940. We worked our way up, hit the high. You got big stopping volume up here. 1940, you got 1,600 lots traded there. The market couldn't get past it. There's obviously somebody with big supply there. And, the market came off, slightly before it. You have a small print. Immediately after it, again, you got a small print. The market did try to go back up. It couldn't take out the high. You get selling imbalances right up near the top of the bars. And, the markets are it just sells right off. Why isn't the market, keep going up? Well, yeah, you can see you have this big volume here. You got to always be asking yourself, what's going on in the market? When you see things that are not normal, when you see big volumes at ends of moves, and the market can't get past it, why? What's happening? There's a shift. Obviously there's somebody with a lot of supply to sell. And they're basically saying, to all the buyers that want to try and take it higher, sure, I'll sell whatever you want, how much you want, I'll sell it to you, no problem. Again, this is similar. You're working your way up, work. Positive deltas. Even this bar, it's a red candle, still got positive delta, so there's still a good buying in there. Right up here near the high, you got a buying imbalance. You're just, 2 ticks off the high, it squirts up. You make a new high. Well, what happens? You got a divergence. The sellers came in. Even, okay, you're willing, forgive this bar. The next bar, again, the sellers have come in. Okay, so you're not yet convinced. This third bar you have here, you got a ratio, a single print, and you got a bunch of selling imbalances in the bar. I mean, if you didn't really notice it in the second bar, in this third bar, it's really quite obvious. So you have to ask yourself, why isn't the market going higher? You see this nice buying imbalance. Where is the follow through? It's not there, and all of a sudden you see the big shift in delta where the sellers are taking over. It's something that, order flows will really help you see. Sometimes it's very obvious, like in this case. Other times, it does take a little bit of work to understand it, but, over time, you'll understand it a lot clearer. So, this is a move, as it's happening, it's going straight up. And, understanding the order flow will help you catch moves like this. You see the point controls all starting, each one subsequently higher, acting as support for the previous bar. The deltas are all positive. You're seeing, single prints on the way up, which is, helping to indicate to you that there is, the market is starting to pull away. Earlier, the market was just sort of, in this area here, in a little bit of a range. But, now you're starting to see, heavy volume on the bid side, which is indicating that there's support in the market. Even though the market's going up, people are trying to sell into the bid to pull it back down, push it back down. You got 1,000 traded here, you got 765 here, 500, 400. and the market's moving up. It's moving up nicely, without much resistance. You're seeing, it's only a few hundred being traded on the offer on the way up. There's some size here. 826 is the biggest amount that's traded on the move up. Here you got 1200. It's the path of least resistance. The buyers are taking it up. And it's not on thin volume. It's decent volume. Each bar is 5,000, 3,000, 4,000, 3,000, 5,000. People are interested in moving the market. Somebody is buying it up, accumulating a position nicely. They're not necessarily overpowering the market and, just buying it up immediately. It's happening over a period of time. This is 1036 up to 1040. It's a 5 minutes, but it's a nice move from 1880 basically up to 1890. It's a nice gradual move. These are the types of moves that you want to catch. Okay, so, this is a E-mini chart. And, come back up, come off a little bit, come back up. You often see that with, with just a normal trading day, where the market's just sort of bing, 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 bing around. And, what you want to do is, you want to catch this move up. You're seeing on the move up, you're seeing some early buying imbalances. You don't necessarily see them later. Then you're starting to see the selling imbalances come in. A couple more buying imbalances as you push a little bit higher. Then the selling imbalances, you got 3 here, 1 here, 2 here, 3 here, 1 here. As the market moves back down, you're not seeing any more buying come in. To a lesser extent, after you hit this high, you got this bar here with, 3 selling imbalances, and a couple of selling imbalances either side of it. And, the market did come back up a little bit, took out the high of this bar. And, and slightly before it, you got a few buying imbalances. But what happens? It shifts, and then you're starting to see the selling imbalances come in on the way down, which is, what you want to see. Here, you thought it was going to happen a little bit early, but the buying came in. You could see that. So had you gotten short here, and you have to stop, here, you could just sort of see that, okay, maybe it's not happening right now. You could get out at a little bit of a scratch or a loss, but then again, when it starts to happen, it's literally around the same price, and you catch the move, from 1904 down to 1899 or lower. I mean, that's what order flows will tell you. They'll tell you the different types of trading that's happening in the market. When people are being, aggressive in the sense that they're overwhelming the other side of the market, and you tend to see that with the imbalances, as they're occurring. When the market is going sideways, it's really hard to get a gauge on the market. But once the market starts moving, order flows will help you determine the intensity of the move. If you're starting to see a lot of imbalances come in as the market starts moving away from a high or a low, that's important. That's where you're going to make money on. That's the value that exists in order flow that you're not going to see on a regular bar chart. I can't stress it enough. Order flows allows you to see, the intensity of a move that you just can't see in a candlestick chart or a bar chart by itself. So, anyway, that's the end of lesson 6, the different types of trading that's happening in the market. In the next lesson, I'll explain the best futures markets to trade order flow. A lot of people ask, what's the best market to trade order flow? There really is no one best market. I'll discuss many of the markets that you can trade. Basically, any market out there you can trade, as long as it's something that trades with a decent amount of volume on an intraday basis. Order flow can be applied to it. I trade a wide range of contracts, from grains to financials to a lesser extent currencies, but a lot of commodities, things that follow supply and demand. Supply and demand is a law, it's not a theory. So, the same laws that apply to supply and demand in the wheat market also apply to supply and demand in the index futures markets. So in the next lesson, I'll explain the different types of markets and that you can trade. Is any one better? It really depends on your risk tolerance and the time you have to devote to trading. But we'll go over that in the next lesson, lesson 7. Thank you.